Hi, I'm Chuck Inglefield, founder of Inglefield Retirement Solutions, and this is my economic update for the third quarter of 2026. For those of you who would just like a quick summary, here is the 1 minute update. The economy is still growing, but softer job growth and consumer spending suggests there's a little less cushion in the ability to continue growing. Inflation is improving, but unevenly, and that's making the interest rate market a little bit harder to predict, especially the Fed and what they're going to do. So we've seen some volatility in interest rates. The stock market's obviously been doing really well, and stock earnings support that, but we've got elevated valuations and we're also in a higher interest rate environment, so that sometimes creates a headwind for stocks. The practical takeaway here is pretty straightforward. Stay invested, stay balanced, and don't rely on predictions of stock market or Fed to change your long-term financial plan. For those of you who would like to understand what's driving this update, let's take a closer look. Let's begin by taking a look at the growth of the economy in the second quarter. And we can see here that the economy grew at 1.5%, which doesn't really tell the whole story because consumer spending and business investment grew at a stronger rate of 3.9%. Now, that doesn't mean demand is still growing at 3.9% because that's the second quarter measure, and here we are in August. We did see a decline in retail sales in July. That might have been distorted because the Amazon Prime Day was pulled forward into June, and then the July demand dropped because all of that consumption was in June. And it's hard to believe that one company can make a difference in these numbers, but it surely can. My takeaway is that the economy entered the third quarter with real momentum, but more recent jobs and retail numbers suggest that the cushion may be growing a little thinner. But the real fear is there a recession on the horizon? And the purchasing managers indexes show that's probably not the case. So when you see the PMI here above 50, it means that both manufacturing and services are expecting expansion, not contraction. So you can see that services is at 54.1, manufacturing at 55.6. Those are the highest numbers we've seen for manufacturing since May of 2022. So the PMI is a really good leading indicator on the economy, are saying that the economy is doing just fine. And even more so, that the activity is broad enough to call the economy resilient. Let's look at jobs, though. This is where it seems like the economy has less cushion than it did before. There were revisions in May and June to the jobs numbers where they took 103,000 jobs off the payroll gain numbers. So you can see in May, we had a gain. In June, we had a gain. In July, we had a contraction in jobs. So this is one thing to keep an eye on. The unemployment rate is still low. And as I mentioned on the prior slide, the July retail sales actually contracted. But again, that could be the Prime Day distortion, and we'll see how it goes. But this to me says, okay, the numbers we looked at earlier were Q2 numbers. Now we're starting to get some Q3 numbers and worth keeping an eye on. Now, employment can be a very noisy data point, which means you really have to look for a trend versus a 1 month number. And I wouldn't even consider this 3 month necessarily a trend quite yet. And with unemployment at 4.1%, that's historically low unemployment, and that bodes well for an economy. Let's move our attention to inflation. This is one of the biggest themes for the last year. And you can see inflation is improving for consumers, but not uniformly at this point, because when you look upstream, you're starting to see inflation at higher amounts. So core CPI, the number here in the middle at 2.5%, that excludes food and energy. And I know that's not realistic entirely, but energy and food prices tend to be more volatile and can distort the longer term trend. You can see headline CPI, which does include food and energy, is 3.4. When you strip out food and energy, it's 2.5. And we know we've been paying higher gas prices, and we know we've been paying higher grocery prices. I'm not sure the grocery prices are going to change much, but if there is some sort of resolution to the Iran conflict, oil prices likely will trend down, and that will help inflation. The underlying measure for producers stayed hot, so that's this PPI. And that argues that we really can't declare victory on inflation quite yet, because often that inflation from the producers gets passed down to us as consumers. all of this impacts what the Federal Reserve is going to do with interest rates. But before we get to that, I actually want to talk about stocks. And a number of conversations I've had with clients recently, everybody's very happy, obviously, with the returns on their portfolios. But there's this sense that there's going to be a shoe to drop, or that these valuations on stocks can't be justified, and maybe there's going to be a big market pullback. And I found this cartoon from back in 2018. 2018, the market actually dropped meaningfully during the year. It was actually only down about 5% for the year of 2018. But during the pullback in 2018, there was a lot of talk about, wow, this could be the next big bear market. And those headlines were pretty scary back then. But let's take a look at the reality. The worst part of the pull down within the year was the stock market dropped 19.8%. Then you can see I've included another data point here. Since January of 2019, so after the turbulence of 2018, the S&P 500 has grown 247% through August of this year. And trying to guess markets or react to headlines has always been a hazardous thing to do. And none of you did that are clients. And we've enjoyed this amazing market 2019 through now. And if you think about what's happened, what's more amazing about that 247% number is we had this thing called a global pandemic right in the middle of that. In fact, we've had two bear markets during that period of time. We had one in 2020, it lasted about 5 weeks, and then we had one in 2022 that started on January 1st of 2022 and it ended in October of 2022. Seeing the S&P 500 grow 247%, including two bear markets in that period of time, is pretty significant. And it's why staying invested and staying disciplined with a long-term plan is the most important part of your strategy. So after a 247% run with stocks, the question is, are stocks now overvalued? And let's take a look at the historic valuations versus the current valuations. And I've shown this slide in prior economic updates. And this just shows what the forward PE ratio, expected price earnings ratio, is for equities. And you can see that recently it came down from around 23 to just over 20 on the forward PE. The average over the last 30 years is 17.2. So we're elevated versus the average, but we've seen the valuation number come down. Now, if you think about it, we're actually at all-time market highs. And how would this valuation measure come down when the stock prices keep going up? And the reason for that is this is a formula of price over earnings. The earnings component tells the story. Let's take a look at that data. If we look at the earnings growth through the second quarter of this year, it's been phenomenal. So it's been at 32%, excluding the unusual items or one-time bumps in profitability. The reported is 50%, but I would rely on that 32% number. And when you see earnings growing at 32%, it does justify higher stock prices because stock prices ultimately are based on earnings. So the forward PE being just over 20, if we compare to the 10-year average versus the 30-year average, the 10-year average is 19, the 30-year average just over 17. So those profit gains have really been giving us the market resilience for stocks. But at 20 times forward earnings, a little bit above that 10-year average, we're paying for that durability, but we might expect a little less forgiveness if we see some corporations missing their earnings targets. But right now, we're just not seeing that at all. In fact, not just the AI and technology companies showing these big earnings. Broader parts of the economy are showing the same type of resilience in their earnings. Let's turn our attention now to Fed policy and interest rates, because there's been a real change throughout the course of 2026 with regard to expected rate cuts or expected rate increases. You can see at the start of 2020, the market was pricing in one, possibly two interest rate cuts this year. And then in early August, we saw a little bit of a bump in inflation numbers, especially that PPI I mentioned. We shifted from expected rate cuts to a rate hike expected within the year. In fact, there was a 65% probability of a rate hike priced into the markets. Then we got that weaker job number in July, and we saw the expectation of a rate hike really come down to 30%. And why is that? Well, the Fed has a mandate. They want to keep inflation under control. They also want to keep a stronger job market. To keep inflation under control, they raise interest rates, which is what you see in that probability number from early August. To keep the job market strong, they lower interest rates. So even though the inflation number came in a little bit hotter, the job numbers have come in a little bit lower. And so it's evened out a little bit that expectation around what they might do. What this has done created a little bit more volatility in the bond market, but quite a shift from the beginning of the year and even in the last couple of weeks. Now, one thing we have seen within the bond market, however, is the longer term interest rates have gone up. And what that does, it actually does the Fed's job for it, where the Fed might not need to hike interest rates because the market's already done it for them. So all of that really plays a factor in what the Fed might do as well. We'll see what they come up with in September. Now let's start wrapping this up. A balanced portfolio doesn't require us to figure out what the Fed's going to do or have a crystal ball for stock markets. The idea is we've got stocks in the portfolio, we've got bonds in the portfolio, each have a different objective. The objective for the stocks in our portfolio is growth, which will provide ongoing purchasing power in the face of rising living costs. And the objective for bonds is often that income and stability. And when we put those two together, that's really what we're doing for the long-term strategy. It needs to survive more than one economic path. We're not trying to outguess the stock market or the Fed. We're just using that balance to navigate those markets. So just a quick summary. The economy remains resilient, but that softer job growth and consumer spending suggests less cushion. The inflation definitely is improving, but it's doing so unevenly. And that's going to keep interest rates and Fed expectations a bit volatile as they have been recently. The strong earnings are definitely supporting stocks, but those slightly elevated valuations, and especially those higher long-term interest rates, reinforce the value of having a balanced portfolio. I always like to include a section here at the end I call focusing on what matters, because as we go through these economic updates, we'll talk about investment returns, but there's something much more important than investment returns. The real return on a life well planned is the freedom to be present for it. I hope you have a great rest of your summer, and we'll see you next quarter.